Let's continue the conversation. Bring in CFRA Research Chief Investment Strategist Sam Stovall on what to do with stocks around some of these uncertainties. And our very own Steve Leisman, of course, Steve, covering the Fed meeting. What's your feeling on this, on the tone that he will strike today as it relates to further rate hikes?
I think he's going to nod to the uncertainty that's out there. I expect him to be sensitive to the story or the storyline about potential credit impact of credit tightening. Credit was already tightening in the economy, Sarah, as you may know. And so this is probably going to deepen that. And it shouldn't be overlooked, the additions that the banking system, especially community and regional banks, make to the economy and the loans that they give. A deposit moving over from a regional bank to J.P. Morgan, with all due respect to J.P. Morgan, I don't know to what extent they're in a position to take those deposits and then on the other side of their balance sheet, the other side of their operation, start originating loans from those new deposits that they have. Probably not. Those deposits become essentially reserves in the banking system that are not put to work in the economy. So that's going to have an impact. There's going to be businesses that aren't going to be able to get a loan to start. People aren't going to get jobs from those businesses that didn't start. And I think Powell's going to be sensitive to that, and he'll be sensitive to that in the guidance. At the same time, he'll do exactly what you say, which is he has to acknowledge the inflation problem he has. So he'll hike a quarter, and I think really rely upon the uncertainty that's out there and say, look, we have time to make our next decision, and we're going to take that time.
Sam, does any of it change your view of what to do with equities here? What you hear from Powell, the signals you get?
I think it certainly could have an impact on the investor confidence and where we go, at least in the short term. Our belief is that they're going to raise by 25 basis points today. They'll probably do so again in May and in June with a terminal rate at 5.375. But then I think that the market will look across the valley, and I think it will start to feel a bit more optimistic that traditionally 9 months after the last rate hike, we tend to see the Fed cut rates. I don't think they're going to be doing that in June, as you mentioned in the preamble here. But I think that certainly beginning of 2024, at least, we will see the first rate cut.
That's later than the market thinks. That means that the market will be disappointed, don't you think?
I could be disappointed in the short term. I mean, we've gone through some disappointments just recently, but I think that investors will look to whether the market is then, as a result, again oversold and take advantage of that. So, the belief is that we're going to be seeing a lot more volatility. I keep saying that I think the market is going to be tracing out the design on Charlie Brown's shirt, basically volatility up and down, price movements following in a similar manner. But then a year from now, we're likely to be higher by double digits.
Hey, Steve, you may have heard Sarah and I talking about the press conference and asking her what she expected. I mean, I'm curious to get your perspective. Is this the most consequential press conference we've had in a while? And where are you going to be, if there is one area, perhaps most focused?
I thought you meant physically. I'm going to be in a seat looking at Powell and raising my hand and asking for a question. I'm a little afraid that a lot of reporters are going to want to ask him about the blame game here. And the trouble is, he has a perfect deflection to the question about who's to blame. And he's got that review he's doing of the Silicon Valley Bank situation that comes out May 1st. I think it's going to defer a lot to that. I think the focus is right where we've been talking about, which is this conflict between the inflation fight and the potential disinflationary impulse that's going to come from banking. That's where I'm going to be focused. I'm also focused, by the way, guys, I don't know if we have that those pictures of the wall that I had earlier, but there's 5 Fed freshmen who are voting this time around. Up until now, it really hasn't been any distinction between the hawks and the doves, but right now, there might be. It may not show up at this meeting in dissents, but it could show up in some volatility, or call it a wide range in the dot plot, right? So you've got Barr. I don't know if I can do this off the top of my head, but you've got Barr, and you have Goolsbee, and you have Logan, and 2 others who I'll come up with in a second. And they've only been at the Fed for a year. All the last 5 months or so, guys, it's been hawk, 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 hawk. There may be some doves who show themselves at this meeting, either in their dots or in the months to come when things become a closer call.
I also think it'll be interesting, Steve, whether we see dissents, if the doves are going to show themselves, if they end up hiking?
Yeah.
Because obviously that's a signal that things could be changing faster in terms of the opinion of the Fed.
Here's a factoid for you, Sarah, which is that we went back and looked at dissents over the last 4 Fed chairs, and the lowest percentage of Powell has the lowest percentage of dissents compared to Bernanke, Yellen, and Greenspan.